Hey everybody, Preston Brent here with our Trader User Group weekly financial roundup for the week ending September 5th, 2014. As you guys know, the past couple of weeks I've been on vacation and kind of a working vacation doing a couple of seminars over in Europe. And now I'm back. Labor Day is done for the U.S. markets, or at least Labor Day holidays here in North American markets. So generally volume starts to come back as the kids are back in school and traders are back from their islands. Okay, so why don't we take a look at the charts? Let's take a look at what's going on here and, kind of how I'm summarizing where we can go from here through the end of the year, at least what the charts are saying anyway. If you look at the screen here, you'll see I've got the monthly chart of the cash index, SPX, up. And I've got the monthly chart because I wanted to just kind of take a step back for just a moment. And let's just kind of look at where we've been and where we could possibly go from here. I think it's important every now and then to be able to do that. So if you can look, you can see the two major highs that were made back in, this is the dot-com bubble back in 2000. I think I've shared this chart with you before. And then back in 2007, 08, when we started the financial crisis where pretty much the global markets gave it up. You can see this drop right here exceeded the drop back in 2002 with the dot-com bubble. But now you can see this is a new kind of bubble. This is not necessarily technology driven, but it's certainly financially stimulus driven. You can see the rate of ascension here. And if you look back here, again, this is a monthly chart. In fact, I would submit that this rate here is even higher than the rate back here for the dot-com bubble. Although back in this area right here, the valuations of companies were 4 or 5 times more than the valuations we're getting right here. But a couple of things I wanted to show you on this chart. As we go through the end of this year and we kick off into 2015, I would not be surprised at all to see the markets eventually come back down and test this area somewhere back down in here again. Now that would be 2015, 2016 looking at the chart. So you can see this was a very strong resistance area until we blew through it. In fourth quarter of 2012, as we started that tremendous run since 2012 all the way through. And of course we've been bullish, but you can see just how steep this slope is. Wouldn't be surprised though to see us come back down and test this level sometime in 2015 or 2016. Again, this is a monthly chart, so just keep that in mind from a timing perspective. Also, I do not see at all any bearish divergence in any of the indicators down here, whether it's the MACD indicator or if we take a look at the RSI indicator. There's no bearish divergence. I mean, there was bearish divergence between the dot-com bubble right here in 07. You can see right there it was just a sliding scale, and then we had this this divergence in the indicators like that. But right here, from this point right here to this much higher point right here, the indicators are relatively flat. So this is a valid move here, but it's been supported by a lot of money coming into the markets. Now we're getting this past week the ECB announced they're going to be putting a lot of stimulus into their economy. Great Britain's going to continue. Excuse me. Great Britain's going to extend their stimulus. They're leaving their interest rates alone. And Japan's going to leave their stimulus alone. So there's still a lot of money going into the markets. And the markets reacted very favorably to the ECB announcement this past Thursday. So now, one thing, if we zoom in on this, and let's just, I'm going to leave it on the monthly chart here, but you can see that I ran a Fibonacci extension off prior pivot highs and lows, and you can see these numbers right here. And the one I want you to pay attention to is the 50% extension at 2022. That is the one that I think is going to provide a lot of resistance for us right up in this area right here. We're a little over 2007 right now. The SPX finished Friday, it closed at 2007.71, and the E-mini futures closed at 2007.50. So I had told our members that I suspect that I would not be surprised to see us hit this 2022 somewhere in this area, this zone, and then get even weaker. But we're getting weaker as we go along. The markets over the past week generally in the afternoon, we've had a strong morning and then more of a sell-off in the afternoon. That indicates more of a bearish action than a bullish action. Not that I'm saying the markets are going to turn bearish, but they're just showing a lot of weakness here. But keep in mind this number right here, as I pointed out to you on this fib extension 2022. This is on a monthly chart. Now, if we come back in and let's take a look at a daily chart. I also ran extensions off daily charts on key pivot highs and lows. And let me just bring it up on the E-mini right here. I'm going to use the E-mini here because they're close enough. They're within 25 cents of each other. So if we look at the E-mini, you're going to see the extensions right here on the E-mini. And I want you to look at where we're trapped here. You can see this number right here, the 38% extension, is at 2022. Again, just like the monthly was a 50% extension off prior pivot lows and highs. This one is a 38% extension. So this, again, is going to serve as a dramatic, if that's the right term, hard stop, or at least a hard resistance for the market should we go a little bit higher here. You can see the market has been very slowly making lower highs. I mean, very subtly, and making lower lows Wednesday, Thursday, and Friday. Very subtle. Friday we closed up towards the upper end of the boundary. We came down and we came very close to testing a prior pivot high here at 1985. But the E-minis were able to finish the day a little bit stronger. I mean, we finished up about 9.75, so we finished north of 2,000. So this is kind of where we're sitting here. I said we could bounce around between these two extension areas here. One's the 2.236 and the other's 0.382 extension here. This one here, if you can't see it, is about 2008. And again, this is 2022. And we're starting to get a little bit, just a little bit of bearish divergence on the RSI. And if I were to show you the MACD, you're going to see on the MACD, not a lot, but if I kind of like just move it down a little bit, you'll be able to see just a little bit of bearish divergence here. From this high point right here to this high point right here. You can see here, very slight, not a lot, but just enough bearish divergence to say that we could come down and test these areas as well. So, which way is the market going to go this week? I would say the odds favor an up move, but a very grindingly, haltingly slow up move. And I think there's more risk to a larger downside movement than a larger upside movement. In fact, I told our members this past week when I came back that I would favor SPX credit spreads to the downside. Make the market beat you. Come back up in this area up here and go out in time and select strikes and do bear call spreads up in this area here. So that's kind of where I'm seeing the market. You can see right here, this is serving as pretty good support. You can see that support area right there. You can see right now this Fibonacci area right here is serving as a little bit of resistance for us. We're kind of stuck in this range. We may come back down and test this area again. The momentum we finished up. Now, keep in mind also the markets reacted very positively to a ceasefire in the Ukraine with Russia. Europe is going to come out with more sanctions against Russia. This has it's a toying cause. The sanctions can hurt Europe. It's the right thing to do, but they could hurt Europe. You could see Europe fall, and if Europe falls, the euro is going to get weaker because they've reduced the interest rates. The dollar is going to get stronger. At some point, it's going to start to hurt the U.S. economy and our exports a little bit more. So again, I favor more things are lining up to favor a little bit more of a pullback. Although right now we're still in a grind mode, and I'm telling my folks that right now I'm about 40% into the long side generally, and I've got more of my money on the sidelines or in cash, just waiting for a bigger pullback so that we can come in and dance a little bit more with the devil, I guess. But the other thing I wanted to show you here is now we're at the E-mini S&P 500 futures. You can see here we're very close to all-time highs, right? Here it is right here. Here are the all-time highs. We took out the prior pivot high right there and then the prior pivot high before that. So we're in this area here where we're at all-time highs. If we look at the Dow, same thing with the Dow. We've got this nice upsloping trend line right here with the Dow. And we we broke it, but we were able to regain it, and we're sitting just north here. But again, with the Dow, we're at all-time highs. You can see right here, we're sitting right in that area there. I got a Fibonacci extension here of 17,287 on the Dow futures, E-mini Dow futures. And we're kind of sitting in this area there. We took out that prior pivot high there. I do not see any bearish divergence on the Dow. In fact, if I look at the MACD, if anything, it's a little bit in an upward slant. And I would imagine with the RSI, you can see the same thing here. There is no bearish divergence on the RSI. And again, but the Dow is making these new highs. It bounced pretty hard off the 200 EMA. And then we're sitting right up just north of this upsloping trend line. So the Dow has got a grind higher mentality as well. And then if we look at the NASDAQ has been outperforming everybody. Look at the NASDAQ, folks. Now I got these regression channels in here just so that you can see the vector of the general movement using regression analysis, just to kind of, the gray line is the center. You can see we're in this downward slope here, and then we had this movement like that, and then boom, we were off to the races. We peeled out of it a little bit, but the 50 EMA held us, and boom, we're sitting just right south of this regression, the original regression channel, which has been running up like this. We've been making higher highs and higher highs. Now, in this one, I will tell you, in the NASDAQ, if the markets do pull back, the NASDAQ's going to pull back a little bit harder than the Dow and the E-minis because it's overextended compared to the other two. You can see we got the bearish divergence here down in the RSI. If we look at the MACD, you can see a little bit of bearish divergence is not as prominent. It doesn't show up as much. In fact, it's one of these kind of things like that. So, and because we've got this little interim blip right there, it kind of negates some of that bearish divergence. So it's very minor. I can look at one of my oscillators here, and it'll show the bearish divergence here. It's fairly minor. I mean, it really doesn't. It's not the kind of bearish divergence that would get me excited as to a potential big move down. Okay, so the 50 EMA is sitting right at this area here. It's going to continue an upward vector along with the 200 EMA. So I could see us coming back down to this area right here, which is around 4,000. For the NASDAQ futures, we're sitting at 4,086. So be a small move, couple of days, and then we're back down here to test this again. If we do make that pullback, I'm going to be looking for a test, a consolidation, and a move higher. That's when I'll add to my longs. Right now, as I said, I'm about 40% of my portfolios in long right now, and I'm going to leave it like that until we get a little bit more of a pullback. I don't want to really chase this. Now let me show you another index that is not quite performing as strong as these, and this is the index we like to follow because it generally leads the market up and it leads the market down. Let's look at the Russell. I'm talking about the Russell futures. You can see I've got the regression lines on here. They're already factored in. These regression lines show the pattern of the Russell. And let's just to make this thing even prettier, why don't we just zoom in for the entire year 2014. This is the 2014 year in a nutshell, right like that. Okay, that's 2014. And as you can see, 2014, we started the year right in that area there, and we're right in that area there. I mean, we're almost back where we started in 2014. It's almost like that. Not quite flat, just slightly up, but pretty much the same. And in between, we've come down and we've tested this hard stop down here, hard resistance there, came down, tested it again there, came up, tested it again there. We didn't quite make it down there this time. I thought we would, but we didn't. And now we're sitting right here, just slightly above the midpoint of this mean right here for the entire year. Now the Russell, the reason why we like the Russell is because it's mostly small cap, mid cap. And when the risk comes back into the marketplace, money tends to flow in the Russell. But right now, this is a little bit of a different market, which has caused a little bit of confusion for a lot of traders. Typically, you will get the Russell leading the way and staying up. The Russell here would look like the chart I showed you with NASDAQ, which was really through the roof. But money is not going into the small and mid cap like it normally does. It's going into larger cap like the Dow. The Dow is leading the way along with NASDAQ making new highs, E-minis close to new highs. Um, uh, the Dow close to the highs, as I said, because the money is going into larger cap stocks, dividend paying stocks, just because of all the money floating around in the market. I do believe that if the rut fails here and comes back down and breaks the 50 EMA, we're going to see the other markets start to fail and give it up as well. If I blow this up, again, this is a daily chart. You can see here, this is a bullish candle here. But like the other candles, we've been making lower lows and lower highs for the past 3 days. As I box in these candles here, you can see it. Now, this candle right here on Friday, we got down almost just north of the 50 EMA right here, and then we closed at the upper end of the trading range for the day. I want to see us take out that high and continue higher. That'll be a very bullish sign. If we don't do that, then I think the market's going to hang up here around the 1180 area. It's a key resistance point. We're going to roll back down as the 50 EMA is continuing an upward vector. It's probably going to come down and find support right in this area here. Okay, so that's around 1157, 1158. Somewhere in this area here is where we could find ourselves very quickly. Okay. Probably early in the week, next week. It's not option expiration week, so let's see where things are going to line themselves up. Remember, the week after next, we got the Federal Reserve meeting. We're going to get more volatility that week. Now, we're going to have more volume coming into the market this week just because last week was a short week. It was the first week back from holidays in most U.S. markets. Or all U.S. markets rather. So most traders, there were still some that were kind of lagging, still on vacation. But this week's going to be the first full week of trading. So these are the main markets that we're watching here. And one other thing I wanted to show you here, if we take a look at volatility, volatility is still sitting fairly low here, right on this support area here. It closed Friday at 12.09. So you can see vol is below the 50 EMA, it's below the 200 EMA. So vol is down very low. But as you guys know, over the past week and a half or so, vol has been creeping up. I mean, there it is right there. It's done one of these kind of rounded patterns like this. It's very insidious. And vol generally spikes to the upside like it did on that day right there. It doesn't just grind higher. We'll have spikes in vol, and then we'll kind of see what the action is. 1350 was the high, roughly, in vol for the past 2 weeks. So that's going to be a key number. If we take that out, we're going to have a candle that looks like that. We're going to be moving up pretty strong. And there are any number of triggers that could move this. But otherwise, right now, we're I think going to be in this kind of low vol environment unless we get any kind of trigger. We're still in this grind up mode now. So that's a little bit about volatility. And the other one I wanted to show you is Treasuries, U.S. bonds. You can see bonds have started to give it up. Now, I went short bonds, and I'm still holding some shorts in bonds here. We gave up the 50 EMA, which is really important. Bonds have done very well for the year. It's very amazing what bonds have done. Let me show you guys here. Just like I capped in the year for the Russell, I'll cap in the year for bonds. If we take a look at it for the entire year, this is bonds right here. We entered the year right there, and this is where we are with bonds. I mean, that is a pretty good performance in bonds for this year. As we start to go into 2015, as we start to get closer to a potential interest rate bump, you're going to see bonds come back and finish, I believe, somewhere in the middle of this range right here. That's where I think bonds are going to be. Somewhere south of the 135 area, somewhere south of the 135, somewhere north of 128, somewhere in here. They're going to maintain low interest rate environment for quite some time, but I do believe bonds will fall off in anticipation of that, much like it did back here in 2013. In 2012. So this is the upsloping trend line that I think bonds is going to break. We may have one final gasp up, but then it's going to roll back down. So that's kind of where bonds is going to be. But normally bonds, by the way, think about this, folks. I mean, if let me just draw this back in here again, just show you guys something here. Normally, And bonds entered the year 2014 there, and now we're sitting right there, almost up towards the high of the year for bonds. And we're also at the high of the year for the Dow, the E-mini, and the NASDAQ. E-mini, S&P 500, and the NASDAQ. So when you have bonds at near all-time highs for the year, for the past year, and you've got highs in all the other markets, that's not a normal market, okay? Um, and as I told my members, one of the primary reasons because there's so much money in Europe, and those bonds are actually the yield in bonds in Europe are lower than the yields here in the U.S. So a lot of money is coming overseas into the bond market, and that's kind of where it's sitting right now. But I think as soon as Europe starts to really get back on the move again, that money is going to come back out of these bonds and it's going to come back over to the European markets. And you're going to see the bonds, instead of being in this area right here, I think it's going to be down in this area right here. So we're short bonds. That's I guess that's the net of what I'm saying coming up. I'm going to be adding more to my shorts as we move forward in bonds. All right, everybody, I just wanted to give you a quick update. We got some other really cool things going in our user group. We got our secret trader session that's going to be starting, or at least our trades. Folks can follow me on trades with email and everything. Come to our website, check us out. We're continuing to grow very quickly. I do some one-on-one coaching. I limit my time. I'm almost booked up in my one-on-one coaching. I could probably sell myself out for the entire week, but that's no fun because I'd rather trade, although I like coaching folks. But I limit the time that I coach. But you should check us out. Check out our website. We got a lot of great things coming up. And otherwise, for our members, I'll see you this Sunday night. Have a good one, everybody. Have a great weekend. And welcome everybody back from the holiday season. Bye now.